Hi, everyone, and welcome to the January edition of the PE Pulse podcast. My name's Pete Witte, and I'm part of the private equity practice here at EY, and I focus on researching and tracking the PE sector. And over the next few minutes, we're going to talk about some of the major themes and activity in the private equity space. So I appreciate you taking the time to listen, and let's get into it. In like a lion, out like a lamb. So that's something that we usually use to describe what the weather's like in March, at least where I live in Chicago. But it occurred to me that it's also a great way to describe how the markets played out over the course of the year last year. You think back all the way back to 2021, we had record levels of activity. Certainly as diligence providers, our phones were ringing off the hook. And a lot of that momentum really carried over into the first half of the year last year. First half, we saw about $500 billion in deal activity. That was a little bit less than what we had seen in the prior year, but it was pretty much in the ballpark. And then, of course, we saw inflationary pressures start to accelerate. People took a step back to assess some of the impacts of the war in Ukraine. Overall, the environment just got a lot more uncertain. And so people got more prudent, right? As a result, we saw a pretty steep drop-off in deal activity in the second half of the year, down about 40% by value and about 30% by volume from the first half. Now, all of that said, I think there's value in putting some of these numbers in context, right? Before the pandemic, $400 billion, $500 billion, that was basically an average deployment year for private equity. Last year, PE firms did deals valued at $730 billion, right? So I know there's sort of a recency bias here, but when you zoom out a little bit, you can see deals are still happening. Firms are staying active, albeit not at the pace of the last 18 months. What is changing, though, is the types of deals that we're seeing and the way that those deals are getting done. And that's likely to be the case as we get deeper into 2023. So let's unpack that a little bit. So these kinds of environments always tend to come with interesting opportunities, right? Where certain types of deals become more interesting. And, that's the great thing about the private equity model, right? Is that ability to flex with the environment. And so the challenges, for example, that we've seen in the financing market, that's precipitating a shift toward middle market deals, right? Packages are a lot easier to pull together there. The valuations tend to be lower. Firms are able to write higher equity checks for their deals. Add-on deals in particular, we saw a lot of activity there last year. That is a trend that we think will continue for the foreseeable future. If you look back over the last decade, for example, add-ons are basically half of the total private equity market, right, versus platform investments. Right now, they're about 60% of the market. Similarly, you look at what's happening in the public market. A lot of really interesting opportunities there now that valuations have come down. Especially in the tech space. Some of these companies were basically trading at 2x what they've been acquired for by private equity firms versus 18 months ago. All of that IPO activity that we saw in 2020, 2021, there's a lot of value to be had for the right assets. And so firms have been really active there. Typical year, we might see take privates account for about 20% of the total investment capital that private equity firms deploy. Last year, it was about 40%. So a very significant uptick. All in, we've seen firms announce about 80 take-private deals valued at more than $260 billion last year. When we look at the types of deals that we're likely to see over the next 6 to 12 months, another is probably carve-outs, right? You think about this kind of environment, it just naturally lends itself to these kinds of deals, right? Corporates tend to focus on their core business in these kinds of periods. They divest non-core orphan assets. And for PE funds, these kinds of deals can be real competitive differentiators, especially for the largest funds. They provide opportunities for firms to leverage their scale, their operational expertise, and they can drive value where others can't. The level of competition for a $500 million asset is a lot greater than it is for a $10 billion asset, right? That's because the level of complexity involved is a lot higher. Infrastructure is another. We've seen a few bellwether deals in that space already. We should probably expect more, where a private equity firm can come in, they can work with the corporate to provide financing at scale for capital-intensive projects. And for corporates, they're able to lower their cost of capital while keeping cash on the books. The semiconductor space, telecom, transportation, renewables, digital infrastructure, mobility, those are just a few of the spaces where these kinds of deals can make a lot of sense. And then lastly, I would just say idiosyncratic opportunities for companies with characteristics that are going to let them perform really well during a downturn, right? Maybe that's a value play. Maybe it's distressed. Maybe it's a company with a long-term fixed income contract, that kind of a thing. And then rotating out of anything that acts like a fixed income asset. And we've seen firms focus on that over the last few months. Now, I think most folks are aware that the syndicated finance markets have been pretty challenged over the last few months, right? Over the spring and summer, banks accumulated a lot of LBO exposure that they then had a hard time offloading as interest rates moved higher, and that limited appetite for new deals. Bloomberg reported a few weeks back that there was more than $40 billion of hung deals sitting on the balance sheet of the banks. Now, not all of that is private equity, but the effect has been the same, right? Higher spreads, increased cost of financing. And the markets remained pretty choppy, right? We've seen a few deals kind of test the market. They've had mixed results. We did see, before everybody went pens down for the holidays, some signs that investors are coming back into the space for certain types of assets, certain types of refinancing activity in particular. So I think folks will be watching really closely this space over the next month or so, just to kind of see how things play out and how things shape up. But all of this has really made it private credit's time to shine. You know, you think about all those take private deals that I mentioned, I don't think a single one of them was financed by the traditional syndicated finance markets, right? Instead, they've either been over-equitized, right, and the sponsors will come back later and they'll layer in some debt, or more likely, they were financed by consortiums of private credit funds. And the deals that they're able to do are getting bigger and bigger and bigger, right? It used to be that $1 billion, maybe $2 billion or $3 billion was sort of the ceiling on that market. Well, we've seen $5 billion deals, $6 billion deals, $8 billion deals. So it really is impressive the way that this market has evolved. You look at a deal like Blackstone's recent acquisition of Emerson Climate Technologies business, right? It's a great example of how firms can employ really creative financing solutions. So that company makes HVAC and refrigeration products. The deal was valued at $14 billion. And in exchange for a 55% stake, Blackstone put in $2.4 billion in cash. They added $2 billion in convertible instruments that can increase their stake at a later date. $5.5 billion in financing came from a consortium of private credit funds. And then $2.3 billion came from Emerson itself, right? And so the features of this deal, right? A carved out asset, seller paper, deferred equity, private lenders, a shared ownership model. These are all levers that firms are increasingly pulling to varying degrees across the market. Now, this won't be the case forever, right? Interest rates will stabilize. The banks will get some of these hung deals off their books. The traditional markets will start to function more normally again. But I do think that when we look back at this time, this is really going to be the inflection point for private credit. That's going to be one of the real legacies of this period of volatility. So bottom line, I think, is that firms will stay active. There's a lot of interesting opportunities out there. They've used the last 6 months to develop some of these alternative financing modalities that I think are going to persist, at least to some degree, even after markets normalize. That's it for today's podcast. Thanks as always for listening, and I will see you next quarter with another update.